Welcome to Lesson 2.11 about pipes and public shell merger transactions. You read a lot about traditional underwritten IPOs in the business media. That is, when the IPO window is open. But the IPO window is often closed because of general economic and market conditions and trends. Even when the IPO window is open, $200 million IPOs underwritten by large syndicates of who's who on Wall Street, Switzerland and Tokyo, is beyond the reach of most companies. But did you know that hundreds of small companies become public every year, whether the IPO window is open or closed? Most public companies have never done a traditional underwritten IPO like you read about in the newspapers. Some people think becoming a public company is primarily an exit strategy, a way to cash out your chips like selling your business. That's true in some cases, but many small companies decide to go public to raise growth capital, not to cash out. Some investors specialize in investing in small public companies. Generally, investors' return on investment or ROI expectations in public markets is lower than ROI expectations of private investors, like venture capital investors. That lowers your cost of capital and dilution compared to venture capital investments because the investment is liquid. If investors can resell if unpleasant surprises occur, their risk is lower than if they are stuck in a declining investment. People will pay for lifeboats and parachutes. Lower risk justifies a higher valuation. Being a small public company, however, has its own disadvantages. If you don't have growth potential, or if you execute poorly, you'll wish you never became public. In this lesson, we'll discuss how do you know whether your business meets the criteria of people who like to invest in small public growth companies. How can you gain access to that capital? What's the upside potential and downside risk of becoming a small public company?